Good morning and welcome to today's webcast. States may use economic nexus to impose sales tax collection. I am pleased to introduce today's presenters, Anna Ferraro and Phil Horwitz. Anna has been handling California and multi-state sales and use tax transactions since 1992. First as an auditor for the state of California, then as a consultant with the Big Four, and finally as a sales tax manager in industry before joining Moss Adams. She serves clients across industries, including technology, manufacturing, and retail. Anna provides sales and use tax transaction planning and compliance, including transaction structuring, determination of product and service taxability, and creation of tools to assist clients with sales and use taxes in daily operations. Phil joined Moss Adams as a director in the state and local tax practice after a 20-year career at the Colorado Department of Revenue. Phil has followed sales tax nexus from the very beginning of his tax career in 1994, and in April was one of the few to get to see the Wayfair oral argument in person. And Anna, I will now turn the line over to you to get us started.
Thank you, Emily. And thank you for joining our presentation on Wayfair today. We have this agenda set. As you can see, we will be starting our presentation with an overview of Nexus. We're going to talk about the physical presence test and how that has progressed and led to Wayfair. Next, we'll talk about Wayfair itself and the results of that case. We will then discuss what to expect next, how the economic nexus is a new standard, and how this is going to affect you. Lastly, we will talk about some of the issues that were not addressed in Wayfair. However, before we get started with our presentation, we do have a couple of polling questions. We're doing this in order to get a better feel for our audience and what your concerns are so far, so that we can focus our presentation more on your areas of concern.
All right. Our first polling question: in how many additional states do you think you will need to begin collecting and remitting sales and use tax? And your options are 25 or more, 10 to 20, less than 5, or none. And I'll give everybody a few moments to make a selection. And just as a reminder, in order to speed up the delivery of the information today, we were not able to offer CPE credit for this course. And these are our first and last two polling questions. And I will close out the poll. And here are the results.
That looks like about what we expected. That's not too 25 plus, about 25%. 10 to 20 is 40%. And then again, about a quarter of participants think it'll be less than 5, and a few don't think they'll have to collect in any more states. That either means that you don't need to be listening to this call because you're already collecting in all 50, or you really need to be listening because maybe there is more out there than you realize. Anna, your thoughts?
No, you hit about what I thought, except for the none, but we'll see.
All right. And our next question: which of the following is your biggest concern? Compliance, registering and filing of returns, determining taxability of products and services, or implementing new systems and process to deal with increased collection and remittance? And again, I'll give everyone a few moments to make a selection. And let's see what everyone had to say.
Oh, really? So it looks like more people are concerned with the compliance, the registry, and filing of the returns. The second concern is more the determining taxability of products and services. And lastly, it's implementing systems and processes. I guess I am a little surprised. I did expect that the implementation would be the largest concern with our audience. Bill?
I agree. I'm a little bit surprised as well. I thought it would be almost the reverse. But we will try to focus a little bit more then on the compliance piece and the registration piece, and maybe a little bit less on implementing new systems and kind of perhaps the streamlined solution to that problem. All right, so welcome everyone. This is Phil Horwitz. As Anna said, thank you all for joining us. So what was the result in Wayfair? As we'll see, we'll go over the new economic nexus rule, the guidelines that the court laid out, and then we'll talk about other issues that the court didn't address that perhaps we thought they would. I mean, from a big picture perspective, what the court did was eliminate physical presence. They approved certain guidelines without setting them out, without explicitly saying this is what's required. We'll talk about what those guidelines are, but it's important to remember that those guidelines, the court said this is enough. So they said this is sufficient, but they didn't say that this was necessary. So we'll see as we talk about each one of those what that potentially means. And then what are the issues that they left undealt with? And that's more than just the remand to the South Dakota courts. There was plenty that the court could have dealt with that they didn't end up choosing to. So with that in mind, before we proceed, let's do a quick review of where we are, how did we get here, really? What's the physical presence history? Now, before 1967, the general expectation, everyone assumed that physical presence was required. It wasn't there wasn't an issue of economic presence even present at all. But by 1967, where you had big mail order catalogs, this is the Sears years, you started to have mail order catalogs that had significant, well, relatively significant for the time, presence in various states, significant sales to various states, but no physical presence. All they did was send in catalogs, take orders over the phone, and then ship those goods by U.S. mail. So the question was, can the states require these catalog sellers to collect sales tax? And in the case in National Bellis Hess versus Department of Revenue, that was I think the Illinois Department of Revenue, the court laid out that physical presence was explicitly required for collection of sales tax. And that was more just a recognition of the long-standing rule that everyone had assumed, and so that was, they said, same thing is true in sales tax. But from 67 to the late 80s, we saw the Supreme Court start to erode that physical presence requirement. They're really, in many cases, get rid of it altogether, particularly in products liability cases. So this is where somebody ships a good into the state, somebody manufactures a good, that they sell it into the state, and then that good injures somebody because it's poorly manufactured. And so people were trying to sue the manufacturers of those products, and the court said, you don't have to be physically present in the state in order to be sued in the state. You just have to purposefully direct your activities at the foreign state. So that was through the late 80s. Starting with the late 80s, as those cases became established law, the states thought, well, we know what the answer is. The answer is you don't have to have physical presence. All you have to do is purposefully direct your activities to the state. And these catalog mailers, these catalog retailers are purposefully directing their activities at our state. And so we think National Bellis Hess is wrongly decided. We think that these companies ought to have to collect sales tax, and so we're going to sue. And they did, and in Quill Corporation versus North Dakota, the Supreme Court, to everyone's surprise, honestly, I think the general expectation in 1992 was that the U.S. Supreme Court would continue its long line of cases and say, yep, purposeful direction applies in sales tax just as much as it applies in products liability. To everyone's surprise, the court did not do that. They did the opposite, and they doubled down on the physical presence rule. So in 1992, they said, nope, we were correct in 1967. National Bellis Hess was correctly, well, National Bellis Hess we're going to uphold. What they really said was, while we might not reach the same solution today, we are going to adhere to our precedent in National Bell SS. That was in 1992. Starting in 1993, the states, having lost the big attack, started to try to whittle away at the physical presence rule through a variety of strategies. And we'll cover the status of those strategies in a minute, but from a high level, remember that those strategies were initially Amazon's click-through Nexus legislation that originated out of New York and was adopted in a whole bunch of states. And then there was a big push for affiliate Nexus, where the states would attribute the activities of one taxpayer in a state to give another taxpayer Nexus. So here we're talking about things like somebody who installs goods in the state that are shipped by another vendor. Then you had Colorado's reporting requirements that were adopted in 2009 and in theory were effective in 2010. Those reporting requirements laid out, they just went all the way around physical presence, and they said, we're not going to ask you to collect a tax. Instead, what we're going to do is ask you to report all of your customers so that we can send them a bill for their use tax. And then finally, you had Massachusetts' cookie nexus approach, which was adopted in 2017 before the court took up Wayfair. And that essentially said, again, that was an effort to get around physical presence by saying the little cookies that are on your computer or the apps that are on your phone are your physical presence. You are physically present in our state because you have put all of these apps on all of our residents' phones. So the cookie nexus issue didn't have much of a chance to bake because the court, of course, granted cert in South Dakota versus Wayfair, and ultimately, as we all know, on June 21st, overturned Quill and National Bell SS. So that's where we stand from a historical perspective. What was the result? What did the court do in Wayfair? Well, they said physical presence is not necessary. As I said, they overturned the requirements of National Bell SS and Quill, and they said purely shipping goods into the state is sufficient. That's all that's required, is that you essentially purposefully direct your activities into the foreign state. Now, they laid out some rules about what it's going to take to make sure that you're not unduly burdensome on interstate commerce, but from a kind of theoretical law perspective, what they're really saying is that we are reorienting our perspective so that it's consistent with the rest of our nexus or jurisdictional law. So what about things like digital goods and services? What about somebody who sells ebooks or audiobooks or movies into a state, or somebody that delivers electronic services into a state like software as a service or data access services? Is that enough? And that's one of the open questions that are left. We don't exactly know, although personally, as I read the opinion, I don't see that there's any theoretical reason why one would be why digital goods or digital services would be any different from shipping the good into the state. Now, you do have that question of somebody who puts themselves out on the internet and allows people to buy their digital products, but doesn't necessarily know where those goods are being downloaded. Those kinds of questions do raise issues of purposeful direction and whether or not the vendor has purposefully directed their activities at the foreign state. But those are really issues that are in the margins, and in general, most taxpayers are going to know where their customers are. And if you know where your customers are and you're selling to those customers, it doesn't really matter whether you've put it into the mail, whether you've put a physical product into the mail, or whether you've put a digital product into their download stream. If you know where they are, then you're purposefully directing, in all likelihood, you're purposefully directing your activities at that foreign state. All right, so our last bullet point on this slide is, what in the world? What am I supposed to do? Should I panic? Well, before we decide whether you should or shouldn't panic, let's take a look at what the guidelines that the court laid out actually were. So over to you, Anna.
Thank you. So the court liked that South Dakota's law provided a reasonable degree of protection for the small merchants and decided that it didn't impose an undue burden on them. The court did not say, as Phil mentioned, that the rule was that South Dakota's specific rule was a new standard. Rather, the court stated that South Dakota's rule was reasonable and that the safeguards South Dakota had in place did not pose an unreasonable burden on a remote seller. So the following are the key points that the court made in arriving at its decision. So first, South Dakota law Nexus is created when $100,000 or more of goods or services are sold into the state, or there are 200 or more transactions into the state. Thus, the state has established a safe harbor that remote sellers can look to in determining whether or not Nexus is created. There are two aspects here that are important. First, the state clearly defined its Nexus standard, so anyone can see that. Second, the court felt that the standard set by the state was reasonable. So this doesn't mean that only a state that has the $100,000 of sales or 200 transactions can assert economic nexus. The court just said those were reasonable. However, you probably will see, or we do expect to see, states will follow this since it is something that the court did say was reasonable. So you're going to see we have seen a lot of legislation. We have seen a lot of states pass similar rules that they can follow. So you're going to see that, and it'll be up to interpretation for those states that have different thresholds, probably lower thresholds. A state with a higher threshold is probably easily going to be considered reasonable for enforcing economic nexus. A state that has a much lower threshold, that's where the question is going to come in is, hey, is this reasonable? Is it burdensome or not? Second, the court said that the rule was prospective. So the fact that it is not retroactive, it does not place a burden on remote retailers to incur a significant expense in paying tax on those prior transactions. So retailers are now aware that they have a burden to remit the tax, and they can collect the tax from their customers. So now keep in mind that this prospective nature of the law only applies to economic nexus. If a seller had a physical presence in the state in prior periods, the seller still may be liable for tax in those earlier periods. So prospective is good, but only on the economic nexus. If you had a physical presence, you're still subject to the state's laws with regard to that. Lastly, the court liked the fact that South Dakota was part of what they call the Streamlined Sales and Use Tax Agreement, or what I refer to as the SST. So the SST is an organization that was created by some of the states to simplify and make more uniform the administration and collection of sales tax. So the court noted that a complex state tax system can place undue burdens and can discriminate against interstate commerce. South Dakota has avoided these potential burdens by being part of the SST. So the SST standardizes taxes, it reduces the administrative and compliance costs, and prevents the collection remittance of tax from being burdensome or discriminatory. So now the components of SST that the court specifically noted were as follows. First, that there's a single state level administration. So the SST requires all its member states to have a single state level tax. So Colorado and Louisiana are examples of states that do not have a single level tax administration. In both these states, and they are not the only one, but in both these states, local jurisdictions may impose their own taxes that are administered separately and require registrations and filings separate from the state. So in those states, you're registering with a state, you're filing your returns with a state, but if you're operating in some of the other jurisdictions, you may have a county, a city, a parish obligation as well, and those registrations are separate than the state. The court looked at South Dakota and said everything is done at the state level. This is a state level administration. This is a good thing. Second, under the SST, there are uniform definitions of products and services. So although many states can impose tax or provide exemptions on similar items, say food or clothing, states don't always define the terms similarly. Thus, what may be considered an exempt food product in one state may be subject to tax in another state. So states who are members of the SST have all agreed on the same definitions for very specific items. So if you're in any state for SST, they all define food similarly. And if they're saying food is taxable or if they're saying food is exempt, you can say, oh, I have the same definition, I'm fine here. However, the SST does not provide definitions for all products. So keep in mind, when the SST gets together and their members get together to agree on a definition, all the members have to agree on the definition. So even though you'll see definitions for, say, software, they don't have a definition for SaaS, software as a service. And some states will look at SaaS as software, some of it look as information reporting, and others look at it at data processing. Next, the court liked the fact that it was a simplified tax rate structure. And what that means is South Dakota had one tax rate. So you'll see certain states that have different tax rates for different products. An example of that is Illinois. So Illinois has a state rate on sales of general merchandise. They have a different rate for sales of food and drugs. And they have a third rate on sales of vehicles. And if you get into the city of Chicago, and you're in certain areas and you do certain activities, you may have some additional local taxes that apply based on that. So keep in mind that the simplified rate structure that the SST and the court refers to doesn't necessarily limit the ability of local jurisdictions to add their own rate on top of the state rate, as long as it is reasonable and it is administered at the state level, it is still okay. Lastly, the court pointed to the SST's requirement that states provide access to sales tax administration software. So sellers who use the software under the provided by the SST states are immune from audit liability. So this means that if there is an error with the software, a seller cannot be held liable for the underpayment of tax. However, sellers are not immune from other issues outside of the software, such as failure to document an exempt sale or misclassification of a product or service. Now, there are other uniformity rules agreed to by the SST, but these were the ones that were specifically pointed out to by the court. So although the court pointed to South Dakota's membership in the SST as one of the main reasons economic nexus was not burdensome, the ability to impose economic nexus is not limited to those SST states. The court was pointing to the SST and some of its guidelines and principles to demonstrate that a state can make its sales tax process simpler and less burdensome. So there are some states that are not members of the SST that do have streamlined, simpler processes. So for example, Hawaii. Hawaii has a general excise tax that applies to all grocery receipts. And it has a general rate and one other rate, a wholesale rate. It is a very simple structure. It has a very simple rate. And even though there are some local level taxes that may add up, it's all administered at the same level. Another state that is not a full member of the SST but also has a simplified structure, at least for remote sellers, is Alabama. So a couple years ago, probably around 2016, I'll say Alabama got pretty smart about this. They set up a special program for the remote sellers. So a remote seller is someone who does not have a physical presence in the state. So remote sellers can collect Alabama sales and use tax at a flat rate, I believe it's 8%, and report and remit all their sales to the state. The state then allocates portions of the tax to the local jurisdictions, probably based on population, something to that effect. And keep in mind, Alabama is one of those states similar to Colorado and Louisiana in that it's considered a home rule state, which means that their local jurisdictions have the ability to impose their own sales and use tax laws and rates. However, Alabama stepped in and said, no, we want remote sellers collecting our tax. So if you're a remote seller, we're going to make it easy for you. We're going to turn around, give you this flat rate, you file one return, cities and counties are still getting their money, and everyone, in theory, is happy. So the takeaway here is that there are some states that are not members of the SST that do make the requirements that are laid out in Wayfair.
All right, thanks, Anna. Before we jump to this slide, I've struggled a little bit as to how to, or we've struggled a little bit as to how to do this order. Before we take a look at some of the non-Wayfair approaches, let's skip to the next slide for a moment. This is really addressing a lot of what Anna has covered or just went over. So, but I'd like to add a few comments. Does a state need to be a streamlined state in order to require collection, right? This is what Anna was just talking about. Probably not, but it needs to be simplified. Note that that's just a probably not. We don't know for certain that's not a hard and fast requirement. We may never know, but it does need to be simplified. Anna just did a great job of outlining Alabama and Hawaii. Compare Louisiana, though, for a moment. Louisiana, like Alabama and like Colorado, has all these local jurisdictions, all of which can impose their own rates and that have their own administration of the tax. Now, Louisiana did adopt a economic nexus statute. Louisiana hasn't been perfectly explicit about what they're going to do after Wayfair, but there was a news story in one of the local papers, I think on the 5th or 6th of July, that said that the department had indicated to the paper that they were going to, that they did not think that they could enforce their existing nexus, economic nexus law, and that they first need to get what they call the Louisiana Sales and Use Tax Simplification Committee, or Commission for Remote Sellers, that Louisiana body has to meet and come up with some kind of guidance. All of us think that it'll look a lot like Alabama, what Alabama's done. But Louisiana is essentially acknowledging, although they haven't done it publicly yet, that they don't think that they can enforce their law at the moment. Now, Anna also covered retroactivity and noted that it has to be prospective. Notice that Hawaii has asserted retroactive application for what appear to be their own reasons. They have a very unique structure. That general excise tax is a little bit weird in that it's imposed directly on the vendor. There are a lot of states that have that structure, but those states still consider those structures to be sales tax structures. Hawaii really goes all in on this idea that it is the vendor's tax. And so from their perspective, their argument is that this is a tax on all of your receipts over the entire year. And so if you exceed the nexus threshold, you have to pay that tax that looks an awful lot like a sales tax and smells an awful lot like a sales tax and frankly quacks like a sales tax. But their argument is that because it's different, somehow they can impose it on the entire year from January 1st of 2018. Whether or not that's true, some taxpayers likely to take that on, and my personal view is that they've gone a step too far and that they probably cannot maintain that position. So there you've got Hawaii. And then what about that minimum $100,000 threshold? It probably has to have a minimum threshold of some kind. The court was pretty clear that that safe harbor is important to their analysis of whether it's unduly burdensome or not. But I don't think there's any magic about $100,000. Some states have adopted a $250,000 standard. So Mississippi, for example, you can probably expect a similar standard in some of the bigger states. Notice, though, that Mississippi, interestingly, has done it by rule, not by statute. So remember when I was talking about the history a few minutes ago, talking about in 1992, the states really expected that they would win Quill rather than lose Quill. In anticipation of winning Quill, frankly, just as you saw in anticipation of winning Wayfair, a bunch of states modify their statutes. Well, back in 1989, 1990, 1991, in anticipation of winning Quill, a lot of the states modified their statutes to assert a pure purposeful direction standard. And so Mississippi was one of those states that adopted a pure purposeful direction standard. Now, after Wayfair, they've come out essentially by rule and said, well, our existing statutes that are those pre-Quill statutes that assert a pure purposeful direction standard, well, that's enough. And we're going to limit the application of that by adopting by rule a $250,000 threshold, but we don't need to go back to the legislature to have new legislation. So that's an interesting note. I think they're probably right. Mississippi is not the only state to have done this. I think Wisconsin did something similar just in the last few days. So that's that issue. And then, of course, you've got other states that have adopted a $10,000 threshold. That $10,000 threshold really originated with that New York Amazon click-through Nexus statute, but it's migrated from there into marketplace collection. So you'll see in Oklahoma and Pennsylvania, they've both adopted structures that require you to either report, like the Colorado reporting, or collect, and they've applied it against marketplaces as well as the marketplace vendors. So the marketplace facilitator itself is the one who has to collect the tax and has to collect it for any vendor that has more than $10,000 of sales in the state. Minnesota's taken that theme and put it to a slightly different tune. They've said if you have $10,000 of sales through a marketplace that itself has physical presence in our state, you, the remote vendor, therefore have physical presence. Regardless of whether they've stored your inventory here, regardless of anything else, if you have $10,000 in sales through this marketplace facilitator, you have Nexus and have to collect tax on all of your sales. So those are all riffs on the issues that Anna just went over in terms of what the Wayfair court laid out as requirements. So let's come back one slide and take a look again at the other approaches. What's left of the other approaches that were adopted from 1993 to 2017 before the Wayfair decision came down? So remember, it's not on this slide, but the first item was that New York Amazon click-through Nexus approach. And a lot of states have it on their books. That's why it's worth talking about for a minute. But the reality is that those standards were already pretty well accepted as constitutional. I don't think the Wayfair decision does anything to change that. Wayfair almost certainly makes that any lingering questions go away, but it was already pretty well established in any event. And the other thing is, it's a pretty poor approach. We saw with the Amazon click-through Nexus approach in every state except New York, Amazon terminate its affiliate relationships in order to get around it. And there are other ways to get around it, ways to structure your contracts with your affiliates to get around it. So it hasn't proven to be a particularly effective method for the states. So I think those states that have it on their books, it'll probably stay on their books, but I don't think it has a lot of application in the real world post-Wayfair. Excuse me. Item number 2 is that those affiliate nexus laws that I talked about briefly, the things like having someone come in and install a good that you shipped into the state, or having someone come in and repair it. Those were all different approaches, and of course, those approaches have been expanded to include marketplaces, so that a marketplace may now be an affiliate of someone that gives you representational nexus in a state, because they, by being present in the state, advertise your goods or market your goods, and that might be enough to trigger this affiliate nexus requirement. So those statutes remain on the books. Again, they're more, they jump off from the point of a physical presence requirement. But remember that there are only 22 or so streamlined states, and there are the remaining states that have some additional degree of complexity. What that additional degree is, varies wildly, but these other approaches are going to be ways that they can get around the restrictions that Wayfair imposes and can force people to collect tax. So that leaves us with the reporting legislation. The two big items, I think, are the reporting requirement, the Colorado reporting type statutes, and the Massachusetts cookie nexus type statutes. So a lot of states have adopted the reporting requirements. A lot of them have done it in the context of, for example, Washington and Pennsylvania, where they've done it not only with respect to the vendor, but also with respect to the marketplace facilitator. And the thinking is that that people are resistant enough to having their information shared with the department that taxpayers will choose to collect instead. But if they don't, the states will presumably send a bill to all of those customers, their in-state residents, that have purchased goods but not paid use tax on them. So I think those reporting requirements had already proven to be effective in getting vendors to start collecting rather than complying with the reporting legislation. So that reporting legislation is one area that remains out there, and that a lot of states that may not be able to meet the Wayfair kind of safe harbors may yet get you to collect sales tax in their states. And then the last remaining piece is the cookie nexus approach that Massachusetts pioneered, and I think this is one that is for the states really the silver bullet, because there is almost no vendor today that operates without using cookies on people's browsers or apps on people's phones. And so those states that can't comply with Wayfair and that choose not to simplify may well try to force collection through this cookie nexus approach. Now, of course, it hasn't been litigated. We don't know whether the court would find that that cookie nexus is constitutional. But there was a fair degree of discussion in the majority opinion. It's all in dicta, but the court suggested that they accept that these cookies on your computer or apps on your phone are a physical presence in the state. And if that's true, if the court accepts that they are physical presence, then I think a Massachusetts-style approach probably wins. So the important thing before we move finally to marketplace collection, the important thing to note about particularly the reporting requirements and the cookie nexus standards, so the only states with cookie nexus approaches are Massachusetts and Ohio that I'm aware of, and Ohio's I don't think is effective yet. I think their effective date was their effective date was 1/1/2018. So the important thing to note about those two is that you have some retroactive exposure if you're looking at a cookie nexus state or a reporting requirement state. Those approaches are not subject to the Wayfair prospective only requirement, and so that's what's important to remember about those particular states. Finally, we'll talk briefly about marketplace collection, and just note that it's the last remaining issue that the states really have. I mean, it's one thing to get Nexus over 1 million vendors, but the states don't want 1 million new sales tax filers. They really don't. They want to see the big marketplaces collect the tax and remit the tax because it's simpler for them and simpler for you, quite frankly. And so states are going to continue to push on the marketplace issue and try to make sure that they shift the collection obligation from the vendor to the marketplace, at least for those vendors that don't have huge sales into those states. So with that, we are on to what is next.
Thank
Anna,
you.
did you want to pick this up?
Yep. I'll jump in on that first part. So what's next? So many states have issued or plan to issue statements that they are currently evaluating the Wayfair case and will be providing guidance in the future. What we've seen so far, the states that have, the guidance is pretty prominent on their state's individual websites. So if you're concerned with a specific state, probably the best course of action is to bookmark that state's website and check it regularly. We do expect many states will follow the South Dakota law and use the $100,000 or 200 transactions at their guide because it was deemed reasonable. Effective dates for states will vary. Some states already have these rules in place and have indicated that either July 1st, 2018 or January 1st, 2019 is the effective date for the economic nexus. However, even though some of these states have a date that is already passed, July 1st, as an effective date, we've seen and we believe it's possible that states are going to, many, not all, will delay implementation for a short period of time just so that they can get their own policies and procedures in place. Because as much as they want you registering and they want your tax, last thing they need is a bunch of vendors jumping on all at once and just a deluge of registrations that they can't handle. As Phil mentioned, there's 22 states that are members of the SFT. So in theory, they would currently meet at least the simplification requirements set forth by the court, but not all of those states have an economic nexus in place. That does not mean they're not going to implement Wayfair and require remote sellers to collect and remit the tax. So plain along the lines of what Phil said about Mississippi, a lot of states do have, whether it's, purposely directing your activities to the states. Many states have a clause similar to California's, and California states that a seller that has nexus or defines a retailer engaged in business in the state to include, quote, any retailer that has substantial nexus with the state for purposes of the Commerce Clause of the United States Constitution, and any retailer upon whom federal law permits the state to impose a use tax collection. So based on that and following along with Mississippi is they don't believe they need any legislation to further implement economic nexus, at least from the standards or the ability to do that. I think what you're going to see is states are going to focus on the 100,200 transactions, and they're going to ignore the simplification aspect. I don't expect states, generally speaking, to ignore the prospective nature of the ruling. We do expect states to not want to go back retroactive, Hawaii being an exception. But as you can see, the clause that most states, or not most, that some states have in their statute is pretty broad and is meant to capture any activities allowed under federal law. So we do expect most states to jump on in some way, shape, or form. And unfortunately, some states will do it very purposely and will have it well thought out, and other states are just going to jump in. Phil, you want to talk about Hawaii?
Sure. Well, I think we've covered Hawaii and Massachusetts and really Minnesota. I think the points there were just to note that that those states have different approaches, so slightly different approaches that you need to be aware of. So with Hawaii, an assertion of retroactivity that, as I suggested, may or may not be constitutional. Massachusetts, a retroactive application, just as with all of the reporting states, and then Minnesota, this very kind of odd nexus through marketplaces and their $10,000. All of which is to say that even though we've got now a Supreme Court case on point, every state's implementation is still different, and you still need to know what's going on in each state. I did want to touch on this last item of will states be kind, because that's been a topic of discussion among practitioners, among state administrators. What will states do on this front? And Hawaii is the exception, but most states are adopting a 10-1 date. October 1st, and that's of course because they want to capture the holiday shopping season. Notice though that the National Conference of State Legislatures put out guidance that suggested that a 1/1/2019 date would be better, and frankly, it would be much better. We have seen a couple of states adopt a 1/1/19 date, but most states are tilting towards this 10-1 date. The longer they take to get guidance out, I think, the more difficult it's going to be to adhere to a 10-1 date. I think the slower they are to get their act together, the more pressure there is likely to be to push out to 1/1/2019. So I think, in general, states will be kind. I think there's a lot of pressure, as Anna suggested. It's not just external pressure, but internal pressure too. They've got to get their own house in order before they can expect vendors to have their house in order. So with that, how does that affect you, Anna?
Yeah. So first, don't panic. We see a lot of people throw their hands up in the air and running around, and we know there are changes are coming, and we know there's a lot of changes coming. It's kind of indicated by the polling. There's going to be a lot of registration. You see the compliance burden increasing significantly. But running around and randomly registering states without understanding where your sales are, what your responsibilities are, and the impact this will have on your operation, it could cause a lot of chaos and could actually result in errors that are more expensive than taking more of a methodical approach. So first, you need to determine the states where you need to register. And you start by looking at where are your sales? Which state are your sales in? What's the sales volume? Which sales have the largest volume, and are those sales taxable? So do states that you have the largest volume and meet these guidelines? So whether they meet all the guidelines set out by the Wayfair case, the reasonable, we'll just say for now, the 100,000 to 200 transactions, the proactive nature of the law, and the simplification, I think most states are going to say that they have the ability to implement Wayfair. So if you're having significant sales and your sales meet those thresholds set out by the state, you're probably going to be looking to register in the state. But next, determine the taxability of your product services. You may have significant sales of a product into a state, and maybe it's more of a service, but if the state does not tax your service, why would you want to go and register? So some states are very much what we call a tangible personal property state, like California. California only taxes tangible personal property and some incidental services. So most services are not going to be taxable in California. There would be no need to register if all your sales are sales of services that are not subject to the tax base in California. So do get an understanding of the taxability of your products and services, and obviously the more complex mix of products and services you have, the more complex being able to determine the taxability will be, but also take a look at exemptions. So many states have exemptions, say, for a full manufacturing exemption, or may exempt clothing, or may exempt food. States tend to enact exemptions that play to the key industries in the state. So understand what exemptions are out there. So maybe you do have a lot of sales in a state and they're mostly exempt. And I'm not saying don't register in a state, but maybe that's not as high of a priority as a state that doesn't exempt your product and service. And so even though you have fewer sales in a different state, your taxable sales may be much higher. So definitely understand that if there are exemptions out there, that what documentation you will need to maintain and support those exemptions. The SST has a multi-state exemption certificate that can be used by its member states, so not by all the states. But being able to send out one document to your customers and maintain one version versus many is a lot easier. There's also the Multi-State Tax Commission, or the MTC. They also have a multi-state tax exemption certificate that covers most, if not all, the states. And they do have footnotes on their document that indicate any limitations on the use of that certificate. Finally, and this didn't seem to be an area of a significant concern for most people, is set up your processes and systems to collect and remit tax. So if you're currently on a manual process, you can find this a lot more challenging than if you currently have a software system in place. Or if you do have the software system in place, I can see definitely where your processes may not be as difficult. So again, the complexity of the products and services, or your mix of products and services, and the volume are going to be a good indication as to how much help you're going to need or how much work it's going to require. So remember, one of the provisions of the SST is that its members, and only those 22 full members, must provide free software to assist in the collection and remittance of tax. So at least with those SST states, you will have that software available. It may not be ideal. It may not be the best solution long term. But see if it's a viable option, because even if you're looking at it as a short-term solution, it can get you over the initial hump of the registrations, well, not the registrations itself, but the setting up the collecting, the remitting the tax. And at worst, most states do have a lookup function on their own state website, where if you put in an address, it will indicate what the proper rate is. Now, obviously, if you have a very high volume of transactions, that's going to be a little more tedious, and if you have a handful or if you sell specifically into one jurisdiction or one area of the state. However, if you are going down the road of setting up a new software system, what I do recommend is take the time to set it up properly. And that may sound funny, because you may be thinking, you know what, I don't have much time. I've got to get this up and running. But the way many of these software programs operate is by mapping a company's products and services to a defined product list. And that defined product list by whoever your software creator is are tied to specific state laws and regulations. So if you don't map the products properly, you may get an error. So as frustrating as it may be to sit there and look through 7 or 8 categories of what they deem freight and determine which one applies to you, mapping it to the wrong freight category can cause a big tax liability or a large overcollection. And at least historically, consumers really seem to be really upset if you try to overcollect from them. I do recommend allowing extra time the first few months as you're getting registered. If you need to, short-term, long-term, is go out and find someone to help you do this, whether it's a third-party provider, whether it's bringing on temporary employees. But give yourself extra time to do the compliance for the first month, especially a quarterly return. January and July, peak times, because those usually when the highest volume of returns are due based on states' filing requirements. You're going to find the first time you may have problems with your data. It may not translate well in how you need to report it to the state. You may have, if all these states are going to have everyone registering at once, you may have the state systems actually being overwhelmed. But the last thing you want is to sit there and wait till the last minute and try to file a return and end up with a penalty for a late filing. I also do recommend setting policies for your customers on exemptions. We mentioned earlier about figuring out what type of documentation you need. Don't wait till after the sale to get it from your customer. Customers are not necessarily good about responding after the fact, and then you're stuck holding the bag and trying to decide, can I turn around and charge them the tax now, or am I on the hook for this? Finally, don't forget about those states that you don't need to register, as Phil was talking about. The Colorados out there that have the reporting requirements. So, yeah, you may not be registering because you don't want to have to collect tax in the state and you don't meet those requirements, but you still have a reporting requirement. And there's specific dates and time frames for that as well. So don't forget about those and make sure to plan for those. And if you're in a marketplace, be aware that the marketplace seller may be collecting for you or on your behalf, or if you are the marketplace, you may have that responsibility.
All right. Now we've got a lot of questions that have been that are in the queue, and we had intended to try to leave some time for questions, but we're rapidly running up against our time slot. But we will commit to getting back to all of these questions. So if you've asked a question and we don't get to it today, we will get back to you with an answer or with just a brief response. I'm not going to spend a lot of time on what issues were not addressed. I mean, let's just recognize that there are some questions that are still out there. Is there an income tax implication to the Wayfair decision? What aspects of physical presence does Wayfair leave behind? Is physical presence still an issue even? And then what are we going to do about retroactivity? I did touch on that earlier. Very briefly, let's talk about just a couple of items within the guidelines. So South Dakota required $100,000 in sales or 200 transactions. What about that 200 transaction volume? What if you're an app seller and you sell 99-cent apps and you sell 200 99-cent apps into a state? Can the state really assert jurisdiction over you because of those 200 transactions? The court did not. The court was focused on the $100,000 and on the economic, the size of your economic presence in the state. I don't think that volume number really is meaningful. I don't think that states are going to enforce it. I mean, what are states going to do with tax on $200, right? $14 a year. That seems unlikely to be a big issue. The larger your presence, the bigger your problems, unfortunately. So the larger, just in terms of dollar volume. I don't think that we need terribly much to worry about the 200 transactions or the volume-based side of this. Now, the other side of that coin is, what if you've got just a single sale and it's $105,000? It's a sale of a $105,000 item. And I think the answer to that is the courts are unlikely to be, based on what the court said in Wayfair, they're unlikely to be sympathetic to that. The idea being, hey, the compliance burden is not that hard. You've only sold one thing. You've got to figure out how to collect tax on that one item, that $105,000 item. So I suspect that that it's really all or nothing on the dollar volume, not the transaction volume. We already talked about retroactivity. And then, of course, I do, since I sit in Colorado, I have to talk for just a minute, or for less than a minute, about the streamlined requirements and what about all those locals. I will say that there has been some discussion among the locals and among practitioners, for example, here in Colorado, about the issue of, can a city assert its own Wayfair standard? So can the city of Denver say, hey, you've sold $100,000 into Denver, and we only have one city level administration. We have a uniform definition ourselves. Our rate structure is relatively simple. Can they say all those things and assert that they, at the local level, meet the simplification requirements? I think the general answer is, the general feeling among practitioners out here is that seems unlikely. The focus is on the state level, and the state is the player in our federal system, not the locals. But that issue is out there, and we may see some locals be very aggressive about that. If it were going to happen, it would happen here in Colorado. So just an interesting issue about where I sit locally. But with that, let's, Anna, do you want to quickly go over our takeaways before we move on to a couple of questions if we have time?
Sure. So after going through the whole Wayfair and what's been going on here, the main key points, the takeaway from this presentation should be that physical presence is no longer the rule. Doesn't mean that if you didn't have physical presence prior to this that you can ignore that and just jump in and register going forward basis. Economic Nexus, I expect it in all the states, whether they meet most of the requirements or not, expect there to be something. There will be some uncertainty over the next 3 to 6 months as states respond differently to the Supreme Court's ruling. I do expect some states to throw stuff out there and try to jump in very quickly. In fact, from what we saw, California accidentally released some guidance and pulled it back very quickly, but they seem to be very aggressive on their time frame of when they wanted to start, being that they were looking, I think, at an August 1st start date, but I don't think that's going to happen. Being that it's mid-July and they still haven't issued it. So there's going to be states that do that, and there are going to be states like, say, Alabama or even South Dakota are a lot more methodical and are going to do what I believe is the right thing and, take the time to do it right and get, work with remote sellers and get them registered and reporting. Lastly, don't panic. As long as you take a very methodical approach to this, take a look at where your sales are, take a look at where your taxable sales are. That really should be probably the biggest driver in determining where to register first. And although it's not ideal, if you have to choose a few states to lag behind, obviously the ones with a lower tax burden would be the best choice. So look for advice. As questions come up, you're not the only one looking for answers. So feel free to reach out to people. There's going to be a lot of discussion. You're going to see a lot of articles. You're going to see a lot of information come out about this and how the states want to do it, what's done right and what's done wrong. So just take a methodical approach, plan it out, and you should be fine. I think we've gotten to the end. I don't know if we have time for any question, Emily.
We could probably squeeze in one question. Let's go with, does this apply to all sales or just sales transacted over the Internet? So if a customer calls on the phone and orders a product and we ship it to them, does that qualify as a taxable sale?
So I think the answer to that is pretty straightforward. That in terms of Wayfair, the answer is yes. The Wayfair court didn't care about how the transaction was consummated. They only cared about the fact that you have an economic presence in the state, and that economic presence arises from a sale that you agreed to in that state. Now, bear in mind that there are some like the Massachusetts Cookie Nexus approach. If you really are selling over the phone, you're not going to hit Massachusetts's standards or Ohio's standards. So you've got some protection there. But in terms of the pure economic nexus states, I think the answer is it doesn't matter whether this is over the Internet or over the phone or in any other way, you received the order and you shipped it into the state. Do we want to take that one last question about wholesale versus retail?
Sure, we can squeeze that in. Our company sells nationally. 99% of our sales are wholesale. What about states that impose sales and use tax from $1 in retail sales? Would those states' laws likely be considered an unreasonable burden for companies with very low retail sales into a state?
So
go ahead, Phil.
Go ahead, Anna.
So the court did not differentiate between a taxable sale and a wholesale sale. So if you only have $1 in taxable sale, that's where we talk about, hey, plan out where you need to be filing and such. So technically, under the economic nexus rule, if you have over $100,000 of sales into, say, South Dakota or a state that has that standard, you have a filing responsibility. You may not have a lot of tax due, and so if your taxable sales are focused more in another state and it takes you a little longer to get registered, there shouldn't be any implications on tax due as long as you can document your sales are exempt, but you still are going to have that requirement to file and report in that state. So did you want to add to that?
No, I agree 100%. The court was concerned about your economic presence in the state, not about the amount of tax that was due. And so if you've got $100,000 of wholesale sales into the state, you have a huge, you have a large enough economic presence in the state to be required to comply with that state's laws. So I agree with you 100%. I think that's exactly right. You're going to still have to comply with the sales tax, with the sales taxable transactions, but it probably falls a long way down your priority list, and you should be focused on states where you've got much bigger sales tax exposure. Well, thank you all very much for your time. Emily, did you want to close us out? Have we lost Emily?
I think there's a survey at the end here, but I'm not sure.
Oops, sorry, I was on mute. That is all we have time for today. If you had a question for Anna or Phil that we did not get to, we will be happy to follow up with you after the webcast, or you can reach out to either of them directly. And to close us out, we have a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.